we can start now, right? This week I don't have presentation, but we can just go through the questions. Let's say if you have any questions, you can just unmute and then you can just speak. I think we would just, if there's any topics that you guys want to talk about, just let me know. We don't have to strictly follow the Slido. I think we will give priority to whoever joined the sessions, right? The live session. It's just that just now, this morning, I saw the post from Mark, right? Mentioned about like looking at popular REITs in Singapore and study what other investors are doing, right? So I think you mentioned about like long-time, you are a long-time investor with holding power. Is it safe to say I can slowly build up my REITs portfolio, reinvest dividend, and hopefully 10 years later, I have a stable passive income? So I think we'll start out with this question first, then we go to Slido. You know, when I look at this, right, I think we should look at REITs investment as like a sub-asset class within the equities market. So, you know, in stock market, there's different industry, right? And REITs is the sub-asset class of real estate. Because if you buy a REIT, you are actually buying the companies, right? The holding companies that own all these REITs assets, right? And the business model is very simple. It's just a rental and then collect the rental, like maybe after do some upgrades and so on. And then it's very simple business, not so much like, you know, other tech companies that, you know, they have to do R&D, all the fancy stuff, right? So REITs is a lot simpler. And when it comes to cash flow, also much more predictable because I think they have a mandate to need to pay out certain percentage of the rentals, right? So they want to make it much more, how to say, transparent and not so much pattern, like you don't have to care so much about their overall strategy, right? Because as long as you know what are the assets that they're holding and you know the capacity to generate rentals from those assets, right? I think more or less that's the return that you can expect. Other than type of assets, I think maybe a little bit on to their capital structure, how much is their gearing ratio, all these things you also need to know. But what I'm trying to say is that maybe just treat this as a separate, how to say, like a group of investments, right? With certain characteristic, which is based on rental, right? This is one group. And then if you say, okay, if not just REITs, right, maybe we can look at, let's say, banks, and then that's another group, right? Because their business model is totally different, right? So for REITs, it's rental. For banks, right, it's mostly they earn the returns from lending, mortgage, all these things, right? So they were subject to different macroeconomic factors, and then the growth factors will be different also. For example, for REITs, what we care about is, let's say, if it is a more REITs, then we care about whether whether their tenants are doing well, whether the business is doing well or not. But when it comes to banks, right, then we care more about like, okay, the housing market doing okay? Because if the housing market is healthy, more people are buying houses, and then there will be more mortgage generated, right? So, you know, they are different, how to say, driven by different factors. If you're comparing banks versus REITs. And then if you go to tech or consumer items, that's another different groups, right? So maybe like my advice is that, there's one angle, which is like we look at our style, right? For example, like you can say, I just want to buy REITs, collects the dividends, and then take the dividends and buy more REITs, right? This is how we invest. This is the how part. But when it comes to what to buy, right? Like which investment to buy, then maybe don't look at REITs just because they are dividends and you say, okay, I just want to aim for the dividends. Because ultimately, if you compare banks versus REITs versus tech companies, right? Like, or other sectors, right? What like their long-term returns still have to come back to the fundamental of the business and also the how much cash flow that they can generate. It's not so much on the dividends that they are able to pay, you know. It's always the business, the growth of the business first, and then secondly, out of the growth or out of the free cash flow that they generated, how much they are paying to us in the form of dividends, right? Yeah. So it's all, like I would say, this kind of mindset that just accumulate assets and then take the dividends and just compound the dividends. I think these are all good way or good approach of investment. I think compared to trading, this is like just accumulate assets, right? So much more dependable. Doesn't require a lot of skill also, I think, as long as you stay with the good quality assets, right? So I think that's a good way to approach investment. It's just that when comparing different investment, then you need to understand their underlying business model, and that will inform you to make better selections. Yeah, I think that's my take on that. Anyone want to add on this? We are talking about the REITs questions. That not a question, it's just a comment from Mark, on 10:25 in the group, right? So just want to quickly touch on it a bit. Anyone want to any opinion on this? Yeah, that's right. Because when it comes to dividend investing, right, actually, it is not recommended to buy US companies, because if you buy a US REITs, right, then you will subject to 30% withholding tax, meaning that every $100 of dividend that the company declare, $30 will be paid to the US government, and you only get like 70% of the dividends. So because this is just the accumulated assets, right? And Singapore REITs is also like there are quite a number of high quality REITs. Some of the Singapore REITs, right, they even have assets outside of Singapore, right? Actually, quite a number of them actually have assets outside. So they have assets in Europe, some in US. So I think you can still get exposure that is outside of Singapore, but don't buy those listed in US just because of the withholding tax. 30% is quite a huge proportion, you know.
I see. I'm not. Just want to hear your opinion on this.
Sorry, Martin. I think your mic is just too soft that I can't really hear the content. But I'll just quickly comment the part that I heard what you said. My take is that we should all invest in local REITs. If your focus is into like investing in REITs, you should focus on those listed in Singapore. Just because for Singapore REITs, $100 of dividend that you receive, right? Then you will receive like $100. You don't have to pay the 30% withholding tax. For US listed REITs, you have to pay that 30%, and that alone, right, already like a huge portion that you need to pay to government, right? So it's really not recommended to buy US listed REITs. But for those listed on Singapore, there are many different types of REITs, right? There are mall REITs, office REITs, industrial, and so on, right? And all these REITs, if you go through their annual report and you read their assets, right, they will tell you like, okay, how many percent is in Singapore, in Hong Kong, in Germany. They have a list of assets, and you just need to understand like, okay, what type of these assets, and then where are they located, right? And you can make an assessment on whether you want to buy the REITs. Because let's say if the REITs, there's more than 50% is in US or more than 80% is in US, and you are bearish on US, then you shouldn't buy those, right? You should buy those that assets that you think in geography that are doing well, right? So that one, I don't have an opinion to say, okay, you should buy those that have global diversified risk. That's not my point. My point is that you should buy those listed in Singapore. Whether the assets are in Singapore or outside of Singapore, that one is really up to your own preference.
Yeah. So that's the question I was about to ask. It's more of we have to depend on our own assessment on the conditions or rather what kind of properties that they are what kind of properties that they currently own, and what would be their likely development over the next few time horizons. So I guess you have answered my question. Thanks.
Okay, thanks. I just want to say that your sound quality is perfect now.
Yeah, just now I was using my iPad. Maybe the iPad mic was the default mic wasn't that good, so I switched to my earpiece. Yeah. Thanks again for answering.
Okay, sounds good. Okay, all right. Anyone else want to add? If not, we just go to the Slido. Or hey, I saw Kelvin is here. Billions Achiever also here. Okay. Before we start, I just want to ask Kelvin, any comment on Tesla delivery? Any insight or anything that you want to share? I think you are still on mute. If not convenient to speak, then we just go to Slido first.
Hello?
Yes, can hear you now.
Hello?
I can hear you, Kelvin. Hello, Kelvin, I can hear you.
Hello?
Yes, can hear you.
Okay. So I think they have done very well, especially considering the headwinds that happened in the first quarter. So the consensus came in, they have exceeded slightly. I wouldn't say this is a huge win, but especially with the headwinds, I think they have shown that they are quite resilient in weathering these conditions. Because we need to consider that the fact that if you compare with the competitors, almost every competitor is down by in the US market is down by double digits. So I think, and also historically speaking, the first quarter of every year is very slow for automotive companies. So I think that will be quite exciting to see how they will grow further in the future. So hopefully that the pandemic problem in China will be reduced, and also hopefully the supply chain gets better. And lastly, the Berlin and Texas can quickly serve the demand that has. And one more thing I want to add is that the inventory now is very low. So there is a risk that if Tesla were to shut down Shanghai, or maybe for another couple of days or maybe weeks, right, there might be an issue where they will lose a big chunk of revenue because they got no more cars to sell. So there is an issue as well. So just to take note on that part.
Sure, when you say inventory, this is like the cars that has been manufactured, or is it like parts that is like let's say partially manufactured? Yeah.
In car industry, they have they do count the inventory. That means cars that are manufactured and ready, but no seller yet, no buyer yet. Sorry.
No buyer, but or not the inventory in the sense of like materials and half-built cars.
No, because that one is a different part of the reporting.
Okay. I see. Okay. Thanks a lot for the update. I think.
Yeah, this is Martin here. Also, another question, because I've been reading also both sides, right? A lot, the general consensus is they are building. I mean, the results are really considered good in terms of because there are supply chain challenges, right? But why? What makes although there's a lot of differing points like the Tesla bears, right, that says this is not exceeding expectations, although by a slight margin. Any opinions why they will say such things though? Because this is, I mean, at least I don't feel that they didn't do well. So just want to hear some opinions on this.
If you go back into history, right, you will see that the Tesla bears are usually shifting their goalposts whenever they are proven wrong. So I'm not sure what argument are they giving this time, but just look back at 2 years, 3 years back, right? Whatever they say might happen, didn't happen, and then they will change their narrative. So if looking back at history, usually we can know that they are not coming from a very sound basis. So just take what you think is reasonable. Don't take everything what they say is as the truth.
Sure, of course. I feel numbers should speak for itself. So I definitely agree on this.
Yeah, one example, if you look back into the history, right? Last time the Tesla bears, they actually send drones or people to go to the factories and count the cars at the parking lot, So the first thing, sometimes they say, hey, there's no cars. Then they say the factories are not building any cars. It's all a fraud. And then the next few weeks, right, they see, they are full of cars. Then they say, the cars cannot sell because nobody wants them. So you know where they are coming from, lor.
Yeah, I think that's a problem with today's media, right? Because you see there's not much media that try to report neutral stuff. I mean, coming from a more neutral perspective. I think both sides as well, right? Let's say, I mean, people are either bullish and or bearish, and then for those that's bearish, every news is like bad news, and for the bullish one also every news is like good news, right? So I think for companies like Tesla, there's always like different camps. So I think that's also why the two groups very hard to talk to each other. But with that said, I think good thing is that last 2 weeks we have seen interview between Chikeng and also Darren. I think that's a good conversation. Alibaba and Tesla always not when it comes to investors, I think not much overlap. But those are good discussion. Yep. Okay. I think let's go back to the Slido. I think we have quite a number of questions also. Let's start with the first one. Is it a good time to buy into tech now? Is the discount good? Recession coming will affect and drop lower. I'll just pass around first. See anyone want to give your opinions? Kelvin, do you have any view, or Hayden?
I actually have no opinion on this because I don't really time the market much, so I can't really say. Just from my perspective is that I've been buying when it's down, when it's up, just consistently a bit.
Yeah, I think my view also same as you, because I don't know why people always asking like, is it a good time? Is it a good time? Like, what are we comparing against, right? If we are comparing against now versus the 52-week high, of course now it's better, right? So it's cheaper. So, but whether from today's onwards, I mean, if we look at past 1 or 2 weeks, I think the index has been climbing, right? For example, like if we look at QQQ, that is climbing, right? Whether it will continue to climb or whether, let's say, like we will have a 50 basis point hike and then suddenly people freak out about yield curve inversion and another sell-off, right? All this could happen, right? So it's very hard to say, okay, now is a good time or bad time now. I think this is very hard to answer. Is the discount good? I also don't understand what does the discount here mean, because if you compare with like 52-week high, of course there will always be a discount, right? It could be like 1% or 5% discount, or it could be like 20% discount, let's say when it dropped 2 or 3 weeks back, right? Or is it like you are comparing against the intrinsic value, right? If you are comparing against your intrinsic value, then we need to ask like how you arrive at the intrinsic value, what kind of growth rate that you are putting into your assumptions. So this is like no straight forward answer. And the recession things also is another thing, right? Like now, if you watch YouTube videos, they talk about the yield curve inversion. And I think someone mentioned about Adam Khoo's video, right? Like even with a yield curve inversion, it's not like the stock market will crash in the next 3 months, right? It could be like 3 months, 6 months, 9 months, or 1.5 years. Then the correction that will come could be like, 5%, 2%, or 15%, right? So it's like with that, very hard to be used as any indicator that's helpful, right? So I don't have, to be sure, I don't have answer as well. So I'll stop here. Anyone else want to give some comment or your any opinion on the first one?
Maybe just to build on this question, right? Like when we ask about whether it is a good time to buy into tech, but tech can be not just the ones that we know about. How about fintech? Because I think fintech is also fintech companies are also some sort of examples where it's very underexplored at the moment. So
sorry, can you say again?
Like fintech companies, fintech.
For example?
I hear from my colleague who she is also investing in that Square. I think it's wait, let me see my watch. This is
you mean Square, PayPal, this kind of companies, right?
Yes, specifically focusing on fintech. Yeah. I mean, when we say tech, it's a very big broad stroke category, right? But what kind of tech companies also? So maybe that's kind of, maybe that question is specifically on this. And I mean, I'm also trying to find out like the general sentiment when we say invest in tech. What kind of tech, like not disruptive tech or fintech, and so on. So
just to hear like the general consensus on this.
Okay. Yeah, I think you are totally right. Tech now, I think nowadays most companies will have tech. It's just like you can't get away from tech, right? Like, and then under this like big category of tech, there are different kind of techs, right? Some companies say, okay, C Limited is a tech companies, but if you look into the details, right, why we call it tech companies, right? Shopee is a e-commerce business, and then their Garena is a gaming business, right? Then is gaming considered tech as well? So yes and no. But so that's why I said tech is like, this group is just too big that doesn't help us to like pinpoint what are we trying to say, right? It should be much more precise. So you are right that okay, fintech is one group. For example, like Square, or now it's known as Block, and then we have PayPal, and then you can include Visa, MasterCard as well in the same group, right? This I will call it as a payment company rather than like a tech companies, right? Yes, they are tech. They are actually within the companies, right? There are a lot of like different projects try to like leverage on the new technology that's coming to help out to facilitate payment. All sorts of initiatives are. It's true that there are tech companies. It's just that the label of tech companies, just to group all of them together, doesn't help. But with regards to Block, right? Actually, I have some small investment. I liquidated most of them, but I still keep, I think, 5 shares. I don't have view, not much like a very strong view on this area. I think that this, although they are like payment companies, but if you try to understand like how good they are doing, right, they are still very much tied to the economy, because their revenue source, right, I think is still come back to how much payment that they facilitate, right? For example, take PayPal example, right? If you use PayPal to make a payment, right, they take a cut, right? So you can see that if the GDP is growing well and then people are spending, consumer spending are all increasing, right, then their numbers will look good, right? Because they are taking a cut. So it is that simple, So let's say economy is doing well, right? Then they will be doing well. So, but let's say if economy, let's say GDP growth slow down, right? Their numbers will drop as well. So on that sense, right, they are like just normal traditional business, not so much on like anything fancy that will drive their core business. That's I think true for Block, is true for PayPal as well. But come back to Block, I would say one thing that is different is that they are much more into crypto, especially Bitcoin. I don't know what they plan to do. Maybe this one, next time if YCX is around, maybe we can ask him more, because, he pay a lot of attention on all this initiative into like Bitcoin area, right? So I think that's something that set Block apart. But other than that, they are closely tracked with the economy. I think that's my point, my view. Anyone want to,
consider cyclical stocks then, right? Rather than growth. I think they are considered quite mature. So, like examples you quoted, like PayPal, at least in the e-payment space, they are considered quite mature. At least to me.
Martin, I think your voice is like come back to just now, very, very soft already. Can't hear much.
Is it okay?
Still very soft. I heard you say about cyclical stocks. I don't know whether, I don't think we will label this kind of companies as cyclical stocks. Cyclical ones are usually those that have no mode at all. It's like commodity type business, right? Say for example, like within chip industry, right? I think the memory chip compared to like the chip that TSMC are making for Apple, right? The memory chips, they are like completely different. They are like very commodity, like, because among different producers, right, they are like the same. Like if you want to buy a RAM for your computers, right, different brand, I think the difference is not so big. So that's why it become a cyclical, because if the price drop, right, all these producers will keep on dumping, and there's not much pricing power among them, right? So that makes them become cyclical, and cyclical stocks, right, their volatility will be a lot higher also. I think companies like oil stocks also considered cyclical, but for payment companies like Visa, MasterCard, I think these are not considered cyclical stocks. They are just like they're just like the like most companies in the stock market, like economy doing well, they usually tend to do well, right? I think most companies fall into this category. There will be some small category that is considered the cyclical one. Like I mentioned, oil stocks, commodity companies, these are definitely cyclical. And then there's also defensive one, for example, like those items that regardless of how the economy doing, but you will still spend. For example, like those, household items that you are using, right? Other than these two groups, I believe others, the rest will all fall into like just the normal, not considered cyclical. Yeah.
Either value or growth stocks lah. So I understand now. Thanks a lot for clarifying.
Yeah. Thanks. Okay. Let's move on to the next one. How do people balance work life and keeping updated on so many single companies holding? This is a fun one. Who want to go first? No one is helping me answer all the questions. Then I'll come back to Kelvin again. Kelvin, you want to share your tips?
I don't think my current lifestyle can resonate to many people because I don't have a 9-to-5 job. So I don't know what to say also. But when I used to have, what I did, but at the time I was young, I was single, a lot of energy. So I read a lot of those research and industry trends. I started with that, and then I determine trends and apply that to looking for companies that can exploit these trends in the future. So then that's where I start. And then in terms of like, do I research every day or what? There's no . Usually when I decided on like 2 or 3 companies, so I will look into it, spend maybe an hour or so, maybe every 2 or 3 days, just try to keep up with some of the news, and then do a simple like projection. How would they grow in the future? Look at other people's research, and then come to my own conclusions, and then decide the strategy. How would I want to invest in this? Maybe a big portion at the start, and then slowly add on, or maybe start a little bit first. And then for monitoring wise, usually I don't monitor like every day. I don't see the price movements. So what I do is I put alerts on my phone. So if there's like a big news coming up, then it will alert me. So there are a lot of tools nowadays, right? Last time I used Google Alerts, so it's quite useful. And then I do follow their annual reports, and especially the earnings reports whenever available. Usually on the day itself, or maybe 1 or 2 days later, or I read the transcripts from Motley Fool. And then as time goes on, it becomes a routine. It's not I don't look at it as a chore. So for those who maybe work 9 to 5 and has family, right? I think maybe you can have like 30 minutes quiet time every day, or maybe the weekend before the kids wake up or something. Just catch up a bit. I don't think investing should take up too much time unless you are taking it as a profession, like you day trade and everything. So, but everyone has their own way of working, right? So. That's just my point of view from my experience. But nowadays, because I don't have 9 to 5, so I also join communities like this one. So I share my thoughts, and then you guys also, when you read something, you share, right? So it helps me reduce my time to go through so many companies. And we are also we all should be grateful that when the pandemic happened, that everyone started to build up so many of these communities. So it helps a lot. Okay, as compared to when I started like 12, 13 years ago, right? It was very lonely. And the most also is forums, but forums, you also don't know who is who and what is real. So that's my 2 cents.
Yeah, thanks a lot for the sharing. Yeah, I think definitely all this community helps, right? And if you just want to get all the latest information, I think Twitter is a good way, right? If Twitter, you can follow certain people that you respect or you trust, and then you can follow certain stock ticker, and then maybe you just like scroll a bit, you can read like all those headlines, and that can give you a bit of sense like what's happening, right? I think these are all really not something that is necessary actually. It's just like for curiosity. Sometimes you just want to know what's happening, right? Even if you don't know all this latest news, because as long as your investment style is like those like similar to mine, which is like just buy the companies and then just hold it, right? Actually, all these daily news, I would say 90% of them are actually noise now. So you don't really need to follow all of them. I think, yeah, really, most of them are noise, and then not many important news actually. And if there's any important news, people will discuss about it. And then anyway, we are in all this group, right, we will hear about it. I think that's one thing. And then second thing, I would say that also depends on like how much you filter out, right? Because it is very taxing to our like energy if everything to you is important, right? So, for example, like, we have like thousands of companies, and then if you say, okay, I'm looking for companies to invest, I need to know all of them, I need to know all the news, right? It becomes too taxing, right? So what can help us is actually knowing what we want to focus on, and then we need to filter out those that we don't like now, or it's not just we have no intention to invest, right? Say, for example, like I share about my view on, let's say, commodity stocks, right? I know some of them, for example, like, oil stocks, this could be like good investment if you're looking at, let's say, 3 or 6 months or even 1 year horizon, right? It could be good, right? Because oil price is high. But for me, I think this is not like a good investment for me to hold like 5 or 10 years, right? Because it is always cyclical. So let's say oil stock go up, and then maybe 1.5 years later, it could like crashing down, or there could be some correction in oil price, right? I might need to sell, right? So because of all this nature, it doesn't fit my preference, and I just stay away, right? If I know I will stay away from all these commodity or oil stocks, right, then any news of Chevron or like any oil companies, I will just filter out, right? So if I see it, I actually don't see it. It doesn't consume my energy like even a little bit. So I don't care, right? So as long as you have all this proper like filter, right, actually it's not that taxing, This one help you. I think the filter is always good to help you filter out the noise. So this one will take some time to develop the habit. That's my just 2 cents from me. Anyone want to give any response on this?
Actually, something to add on. Even if you get the news, right, usually as a retail trader, you are too late to react already. So that's why it's actually not really important for you to keep up right on the dot. So what I would say is that after you read some news, right, you have to think to yourself, how would this impact in the future? How would this be a long-term impact? Then only you make your own decision, because usually the reaction time, it's impossible that you'll be faster than the market one.
Yeah, that's true. And actually, I do it the other way around, which is that, let's say, every morning I would take like 15 minutes just to look at which stocks, the price movement. I'll focus on those like have huge movement. Then if there's a big movement, right, and if I'm interested with that companies, then I will just look up if there's any significant news. So I use the price movement to become like my, point to me like, okay, I might want to look at this company just to see what's happening. So, I know all this is just like, just to address the curiosity, not so much like after I read the news, then I will know what to do and try to outperform. Right? Not the case now. So it doesn't help at all, because like Kelvin just mentioned, we are always behind those who actually spend a lot of money to acquire the news before other read it, right? So we are always behind. So maybe don't bother so much. But on the curiosity side, I think that's I will consider as entertainment for me personally. So yeah. Doesn't help with the investment, but at least I'm entertained. Okay. Anyone else? If not, we continue. At what point should one call it quits and just buy index ETF rather than pick single stocks? Example, 3 years of underperformance. This is also a fun one. So I'll come back to Kelvin again. Anyone else before Kelvin want to hear your suggestion. Is 3 years enough?
But shouldn't ETFs also be part of your portfolio if you wish to diversify to hedge against all the, if let's say you somehow happen to pick lousy stocks then the ETFs are supposed to be the one helping you to mitigate those losses. Am I right to think it like that?
Yeah. Actually, I totally agree with you. Actually, I was think even more extreme. Is that I know there are quite a number of people when it comes to investing, they will say, okay, I started out investing, right? I should buy companies, right? Buy Apple, Tesla, buy bank stocks, whatever, right? They will start out with single names. I think that shouldn't be the way. Actually, we should all start up with like just the passive ETF, right? It could be like S&P 500. It could be like a VT ETF or those VWRA, those like cover global ETF, right? You should actually start from that. Especially if you don't have any like strong view on any companies, right? So say S&P 500, you start from S&P 500, you can actually build a portfolio. Let's say for anyone that's new, right? You could actually build it to 10,000, 20,000, even 50,000, right? And if you are happy with that, then just continue with that. It will be a standard good good way to invest, right? And then from there, if you say, okay, now I have a good portfolio of diversified companies already, and I have preference on certain companies. Let's say you say, I like Apple as an investment, right? Then you might say, okay, and then why not I allocate out 50,000, I allocate 5,000 into Apple and see how it goes, right? Whether it could outperform, because I buy Apple, I think that Apple will do better than S&P 500, right? Then you can do that, right? Whenever you steer away from the passive, you should ask yourself, like, okay, with this pick, right, be better than the default, which is the passive ETF. And then I would say that actually most people should have at least a portion of their assets into passive ETF. I think that's a good idea, because, you know, if we just invest in single names, right, a single company, right, like you could pick like 3 or 5 companies, and then even if they underperform the market for like 2 or 3 years, if you don't invest in ETF, you don't even know like actually your portfolio is like lag behind the benchmark. And if you are not good at picking stocks, right, why continue to do so, right? Why not just just get the passive ETF? Because that one you are guaranteed to get the market average return, you know. It's not necessary to make money. If you invest in S&P 500, drop by 30%, you still lose money, right? But at least that's the average of the market. And that one you are mathematically guaranteed to get that kind of results, right? Yeah. So I do agree with you.
Yeah, because actually my way of passive investing is via the robo-advisors. I just started out like 1 to 2 years ago for using those tools. So that's why I felt that it only now recently that I decided to go into single stock investing. So of course, inspired by yourself and like people like Darren, right? Long Tesla, long Apple. These are 2 companies that I personally also, after reading so many resources, I am also personally convinced. So that's why I felt that, so as long as we have a backup, which is your passive investing, venturing into single stocks is still is a risk we have to take while we are young. Don't do that while we are like a bit as we age, right? And we don't have that kind of time horizon anymore to weather out any uncertainties. That's what I have learned from you all.
Yeah, I think for those who pick single companies, right, usually this group of investors, they have a very strong view onto certain, let's say, sectors, certain way of investing, certain companies, right? So this is like not a normal investor, you know, like they are very passionate onto one company or a couple of companies, right? So not everyone should invest like this, you know, because if you invest in single companies, right, you still need to like, okay, you are passionate about it, and then you read about it. It becomes that there's a cost in terms of time, right? You spend time to know about it. But if you're really passionate about it, then it's not something that's taxing. It becomes something that you enjoy. But for, I would say, let's say 70 or 80% of the investors, right? Like picking stock is just not their something that they enjoy, right? Then they shouldn't do it. they should just invest and get the market average, which is something that is good return already. And they are guaranteed not to underperform the market, So that, to me, that's a very good proposition. At least they save the time, right? And still get a decent return, right?
Yeah, that is always the best fallback plan, fallback. Yeah. So then only when you are gather a bit more interest yourself, then you only then start to stock pick a bit. At least personally, after all these learnings, that's what I feel. Yeah.
Yeah. For those who stock pick, if you try to convince them to say, okay, you shouldn't stock pick, you should just buy index, right? I think also don't have to do that, because it's like someone that is very passionate about like collecting some toys, right? And then you just tell him that actually you shouldn't focus so much, put so much money buying all these toy collection. You should actually put your money into investment, right? They won't like. To them, it's like, why you care so much about how I allocate my time and money, right? I enjoy doing this, then they'll just continue doing that, right? So I think that's okay as well, but it should be something that is that they enjoy now. So let's say another person that don't enjoy picking stocks, but they force themselves to do it, then I think that's something that's quite funny, yeah. Shouldn't be like that, yeah.
Totally fair.
Yeah. There's preference. Each of us are different, right? We have different preference. Okay, but come back to these questions, right? Like I do get the points of the question. I think the person is asking like, okay, if you try out with stock picking and then you have some result, right? You could be like 1 year you outperform the market, then maybe 2 years you underperform, and then you should review your result, right? And assess whether you are good at picking stocks, right? And then is 3 years really enough to judge whether your stock picking skill is good or not? Now, I think that's the question. I'll answer first and then see anyone want to add anything. I would say that actually even 3 years, right, with stock picking is not long enough to tell you whether you are good stock pickers, because you could be right. Or you could be like picking all the good, make all the good, the correct decisions, but the market just disagree with you, and the market could disagree with you for like 3 to 5 years. So even if you look at in the past, right, if you look at Tesla, which already outperformed the market by huge margin, right? But if you look at the past, there could be like period, let's say like 2 or 3 years period, right, that Tesla just underperformed the market by like 30% kind of range, like a huge margin they underperform, and they don't underperform like just 3 months, 6 months, those short-term fluctuation, right? It's really like long period of time, right? But if your thesis is long-term, if you just stay longer, then it could pay off, right? But let's say if you invested in your company, your pick, and then it just underperformed for 3 years, and then you say, I'm not good at it, and you just sell, and then it just shoot up, right? Then it's also quite painful. So it's not an easy question to answer. I would say that 3 years, if even 3 years is too short, you might need, let's say, like 3 to 5 years, or even slightly longer, just to know that whether your picks is the right one or not. That's my first view on that now. But at the same time, right, there are people that, okay, they choose certain companies, right, and then the stock drop or the stock underperform the market, and they are too confident that they are right when it comes to stock pick. They say, oh, everyone is wrong, I'm actually right, it's just the market disagree with me, they will eventually agree with me, so I will just have to wait, right? So they could average down, they could just keep on waiting, and then if the business continue to like underperform, right, the fundamental of the business keep deteriorating, right, I've seen example that companies actually like just they could lose like 80% of their worth by just after the drop, like for example, after they drop by 30%, they say, okay, I'll just wait for it to recover, right? Then they wait for another 3 years or even longer, and that remaining 70% also gone. So there are cases like that. I mean, when companies fundamental deteriorating, that there's no bottom that they can drop, right? They can keep on dropping until like disappear from bankrupt, right? That's definitely possible, right? So you also need to be sensitive to like, okay, whether this is like whether this is like you are confident on yourself. The risk is that you are the one that could be wrong, right? So that's why I say it's not an easy way lah. So it could be. So there are two risks here. Risk number one is that you thought that you are wrong and then you give up, and actually you are right. So this is the first type. Second type is that you strongly believe that you are right, and then actually you are wrong, and you keep on throwing money in and average down, and all the money just gone, right? That's also another type of risk. Which one is more painful? I can't say. I guess the second one is more painful because that's the real money that you lost, right? The first one is just like, okay, if you give up and move to S&P 500, it shoot up 10x. That's just opportunity that you're missing, right? Maybe still okay. For some people, they will say that, okay, if you shoot up by 10x, the 10x opportunity that you miss, right, is much more bigger than your portfolio. I think that's also true. So I think no simple answer. My suggestion is that just be objective about the situation. Don't just because you invested in the company, don't emotionally too attached. Because once you are emotionally too attached with any companies, right, then it might actually influence your view, right? Because you are no longer objective about it. So I think that's something that it could become a blind spot for you. So maybe talk to people. Let's say if you are in this kind of situation, right? Maybe you can talk to people that have like different views, someone that you respect at least, so that you can hear the counter arguments, right? And then from there, just have an objective opinion and make the decision accordingly. Okay, wow, long answer from me. I just want to stop here, see anyone want to respond on this.
I think it is also important to know the reason for the underperformance. Like what Punti said just now. Is it due to my inability, or is it because the markets are unfavorable at that time? Right. So I think the most important thing is to know why you are underperforming, rather than just saying that, okay, after 3 years, if I don't beat it, I will go to ETFs. So because in my opinion, right, the real wealth is really made when you can, beat the market. If you are just following the market, it's quite hard to really get life-changing kind of money. So everyone should have a chance at it as well. So, different people, different folks got different strokes. So some of them are risk-averse, right? So I can't say for everyone, but more often than not, real life-changing money comes from those who take the risk.
Well, what about STI? When I look at the STI, it looks like a basket of white elephants, except some banks and REITs. Yeah. So, what about the STI? Is it? It's also an index, but seems pretty lackluster.
Yeah, I think some people they equate index to like the whole stock market, which is wrong. So you have to really see what constitute the index. So I'm not a well-versed with the Singapore index, but I think it's mostly finance, right? And it's also very tied to the Singapore economy. So that is also a issue. Some people, in most cases, you do not, instead of picking stocks, right? Sometimes you have to also pick the index. So it's not not saying that every index will be performing well in the long run. But I leave it to others to comment on Singapore.
Yeah, I think if you mention about Singapore STI, and then I mean, just from your tone, right, I can sense that actually you are not coming from like, okay, I strongly believe that STI will do well, right? You're coming from a very skeptical kind of tone that what about STI, right? If you are skeptical on STI, then just stay away. Because to me, I mean, when I say about all these passive ETF, right, what I mean is that truly like global kind of like diversifications across countries, across sectors, right? That's why I always mention like, okay, VT, ETF, VWRA, this kind of like really global. And I'm okay with S&P 500 as well, just because like US market is like more than half of the global global equities, right? So that one I will consider as truly diversified. But come back to STI, right? This is 30 stocks that is in Singapore, which is like a very tiny economy out of the total global economies, So it's very, very small, and it's almost like become like a, how to say, like a sector bet, like very small kind of niche sector bet. Like, for example, someone mentioned about the Hang Seng Tech ETF, right? And say, oh, so Hang Seng Tech ETF, this is a passive investment, right? And it could still drop by a huge percentage, right? That doesn't, it's as if like the diversification doesn't help at all. But you have to understand, right? Hang Seng Tech ETF are those companies that is listed on Hong Kong Stock Exchange, and they only focus on tech companies. So it's become very niche. Same for STI, I would say that this is also very niche in the sense of they only exposed to mainly exposed to Singapore economy, and then is like higher concentration or exposure into 3 banks, SGX, and also Singapore REITs. So it becomes very niche. And if it's niche, right, it's good for those who really strongly believe that, okay, I really think that Singapore banks, REITs are good investment. And to make it simple, I don't want to pick like choose which out of that 3, which one is the best. And out of so many REITs, I don't want to choose which one is the best. Then I just get STI ETF as something like a basket, right? Then I think it makes sense for this kind of people to buy into STI ETF, right? But let's say if you have any doubt, right, you shouldn't get into this kind of investment just because of it is kind of niche. Say for example, like if you are into, let's say, chip, right? I always take all this chip manufacturing or chip industry, semiconductor industry as an example. So, I think people mention about like should I invest in SOXX, right? That's the semiconductor ETF, right? So I think my view is the same. That one is an ETF. It's supposed to be quite diversified, because if you look at the list of the companies, right, it's not like 10 companies, it's more than that, right? And then in terms of the semiconductors that's in there, there's different type of semiconductor doing different value chain. So they are diversified from that sense, but it is still a semiconductor ETF, right? So it is a very niche ETF. So you only buy that ETF if you are bullish on semiconductor. So same for STI, you only buy STI if you are very bullish on Singapore, right? So I think that's to pretty simple. It's like that. It's easier that way. All right. So sorry, can you repeat again?
Hello, can you hear me?
Can hear, but keep it short because quite soft the sound.
Hello.
Yes.
Hello now?
Yes, better.
Yeah, it's better. Okay. So let's get back to the question about at what point should one call it quits and buy index ETFs, right? So if you look at the history in the past when Buffett was running his partnership and he decided to stop his partnership because the market was getting very frothy, means very, very high. So he encouraged all his existing shareholders to actually go to a guy called Securian Funds, right? And that guy is called William Run or something like that. And he underperformed the market for the next 6 years. So if your benchmark is to look at the market and think about look at the last 3 years of results and think that it's horrible, I need to quit, then you might be missing the boat. So I think I shall speak for value investors because that's how I invest. If I want to know whether I'm on the right track, what I will do is I will lay out my ideas to somebody far more experienced and who had a very long and successful track record. And when I mean long, I mean more than 10 years. And I will tell him my thesis for a company and let him decide if I'm worth my salt. So that's how I decide whether I should continue to invest, rather than just looking at results and determining if you should continue. Yeah, that's all.
Okay, thanks a lot. Okay, let's move on. I think there's still a couple of questions that we can go through. Yeah, thanks, Mun Song. Okay, Jpowell said he will bring inflation down, the war not easing, and the commodity prices remain high. A few 0.5% possible. Will market react nasty if there's 0.5%? I think I'll go first. I think 0.5%, I think if you look at the CME website, right, I mean, the implied probability, I recall it's more than 50% chance that we are going to see a 0.5% hike in the coming FOMC meeting. Whether this is like a big thing or not, I doubt so, because as you see, right, all this could happen, and before it happens, the market already kind of expecting it to happen. So if market already expecting it to happen and it happened, right, it becomes something that is everyone knows. So no surprise here. If something that is not surprising that come out, right, market will not move a lot just because of that news. So and even with a 0.5% increase, right, the cost of financing is still considered quite low at the moment. As of now, I think no issue. They could hike, let's say, even another 1%, still no problem, I would say. Usually when it's slowly going up, right, it's not like now the news come out, the hike is effective, and then we straight away see correction. Usually not the case. Usually the correction happen when first, when market not expecting this kind of news that come out, right? Like all this tightening news, right? Market haven't realized that this is coming, and suddenly it's coming. Just the news that come out, right? It become a surprise news, and then market might react. Okay, they might react a lot or a little bit, depending on how surprising it is. That's number one. And then number two is that once this all this like rate high, we're talking about like 0.5% or even 0.25%, right? You do it over like a couple of months, one hike and then one hike and then one hike. After 1.5 years, right? Suddenly we are not at 0.25% anymore. We could be at 2.5 or we could be at 3% already. That's the short Fed fund rate, you know. So Fed fund rate is, let's say 3%, right? Meaning that the mortgage cost, mortgage financing, it could be higher, right? So let's say for us, we do we lend, take a margin from IBKR. There's a spread on top of all those LIBOR funding, right? Then we could be paying more. It could be like 4% that we are paying, right? And let's say at 4%, that's already become so costly that people will just like, okay, unwind their leverage. For those who want to buy house, they might not want to buy, or they might not want to buy house at such a high valuation. They will try to lowball to buy houses, right? And then you will see that, okay, that high interest rate started to affect the economy, slowing down the economy and helping to bring down the inflations, right? And that's when we will see like what's the impact that coming from all this rate hike. As of now, I don't think we will see that soon. At least for, I think even for this year, maybe we are not seeing anything yet. I'm actually much more concerned about next year, just because all this rate hike, right? If they do it too fast and then it shock the market, and also something that is hard to manage. Now they communicate it so clear that what will happen, and then they gradually increase it. I think the downside of doing this is that then people will just say, okay, cost of financing will increase, but we just chill first, because the music is still playing. It's just that the volume has toned down a bit. The party hasn't ended yet, and then the market is doing okay, right? Even now, you look at S&P 500, how much it is down versus the 52-week high, right? It's not much, right? So I think the party is still going as of now. But end of the year, next year, who knows what could happen, right? Yeah, that's my take. Anyone want to comment on this? Okay, if not, let's continue the next one. Is anyone thinking that the US market is being too optimistic now? I think I've answered this one. Yes, I think it is a little bit too optimistic now. It doesn't seem that market is factoring all this like tightening that's coming, right? But I'm not saying that market is wrong, because let's say if the economy pick up, right? Actually, economy is not doing badly now. Let's say if the inflation suddenly just cool down, and then the growth are all decent, right? And I don't think we are going to see a correction. It really depends on how the economy is doing, how the corporates is doing. So the market could be right also. But I'm looking at the, let's say, the index level as of now. We don't see any panic at the moment, right? So that's my view. Anyone want to comment on this? Too optimistic? YCX is here. Kelvin, YCX, anyone want to give your comment? No one? Okay, then we continue. Semicon took a beating last week due to analysts saying sales will go down. Good time to buy TSM UMC as pure foundry shortage is still high. Anyone from Semicon? Tim, can you speak now? You want to give any view on this?
I'm in a bus.
Okay. Okay, enjoy your day. Yeah, actually, I think for, analysts downgrade, right? I don't pay so much attention to this. For me, let's say I don't comment on UMC. I haven't really focused on that. But let's say come back to TSMC, right? I think their share price is still like, I think 105 or 106 at that level, right? Still somewhat below their 52-week high, right? And there's still some concern. I think they dropped after all this Ukraine war, and then there's some supply chain issue also, right? That's all true. Actually, I don't focus a lot on this either. My focus is that I know, they spend a lot of money onto the expansions, right? Arizona plants, and then I think they're expanding in Japan as well. So all this expansion, we are not going to see the increase in production that soon. It's not going to be this year. It's not going to be next year. It could be like 3 or 4 years down the road. Then we will see an increase in the production, right? All this capacity take time to build, right? So my focus is really looking at, let's say, 3 or 4 years later. So whether shortage is high, whether all these things, I don't really care. To me, is that I buy now first, and then 3 or 4 years later, once you see they have like all this double-digit growth, and they are able to maintain, let's say, like 40 to 50% gross margin, right? Then all this gross margin will flow into their balance, their income statement, and you will see that their numbers will look good, but that's not coming in soon. So, I'm investing this one for at least 3, 4, 5 years time, right? So I'm very patient about this. I do think that it's a good time to accumulate, given that now the price is not so expensive, right? Compared to, previously. So I will still be accumulating. So that's my take on TSMC. But on this news specifically, I don't have a view.
By the time there'll be a new PC upgrade cycle anyway.
Sorry, can you repeat again? What upgrade is that? I can't read.
I mean, there'll be a next PC upgrade cycle anyway, in terms of people switching their laptops and PCs.
Product always changing, right? So there will be different upgrades. So I think that's all good. Always help to push the demand, right? Yeah. So all good. Okay. Anyone else? If not, we continue. What's the projected outlook of the macroeconomic situation, given that there's a stalemate at the Ukraine-Russia war, inverted yield curve, etc.? Anyone want to go? Want to give your comment on this? Okay, if not, I'll just quickly comment, but I don't have insight, to be honest. First, macroeconomic situations, very, very hard to predict. Like, for example, like Ukraine-Russia war, geopolitical, also very hard to predict. So no insight here, inverted yield curve, whether it will come back again to a normal yield curve, upward sloping yield curve, right? It could happen, right? Or it could continue to invert. I also don't know. Like all these macro things, we can try to understand what's going on the macro side, and then try to rationalize like why the stock market goes up or down, right? All these things we can try to rationalize, but it's very hard to have any insight like what will develop in the future, right? So I think understanding on all these macroeconomics is really will help with our investment decisions. So that's my take on in general on these two things. But come back to this inverted yield curve, right? Maybe I just take an opportunity to explain why, inverted yield curve is something that is quite helpful when trying to predict all these recessions, right? I think the reason is that if we look at stock market alone, right, stock market is just part of the entire capital market. The bond market is actually much bigger than the stock market. So if we look at the yield curve, what we are looking at is actually the bond market, right? So bond market, there are different type of bonds. There are long, there are short bonds, right? What happens when the yield curve inverted is that, for example, the 10-year yield rate, right, is lower than the 2-year rate. And this is very strange because usually if you lend your money to someone and that someone actually take your money away for 10 years, right, usually you will demand for a higher interest rate. But when this inverted yield curve happened, right, it become very strange whereby someone try to borrow money from you. If he borrow for 10 years, then he get a cheaper rate, right? So this one actually doesn't make much sense, one. But why these things could happen is also because of, the buy-sell decisions coming from the market participants. What it means is that there are a huge group of investors, right? They just channel their money into all these 10-year bonds, right? That actually push down the yield. What happened is that when they push their money or they channel their money into the 10-year bond, they actually push up the price of the 10-year bond, right? And the higher the price, the lower is the yield, right? So that's why it caused this yield curve inversion, right? And the question is why so many people suddenly pile their money into the 10-year bonds, right? The so-called the longer bond, right? Why not they just buy a 2-year bond or 3-year bonds? And even though that 2-year bonds can give them a higher yield, right? Why don't they buy that, right? The reason is that this only makes sense if they are very bearish on the market, right? Bearish on the economy. They say, okay, I don't care about the yield is lower, but as long as I'm able to lock in, let's say like a 2.5% 10-year treasury rate, right? I'm able to lock in for 10 years, I'm good. I don't care about like the 2 years, because if the market is not doing well, the 2-year rates might be slightly higher now, but after 2 years it's mature, right? Then you get back your money and you need to reinvest. You might have to reinvest at lower rates, So that's why people are taking cue from the bond market as well to judge whether the markets will be heading into recession or not. So that's why this is very powerful, because the bond market, right, is much more bigger, and there are more institutional money involved in the bond market. That's why the signal provided by the bond market could be something that is quite helpful, because they do something that, stock market participants, right, like equity market investor, they don't see. So they only look at a subset of the total, right, which is a smaller subset. But for the bond market, it's a bigger one. So I just want to share a bit on why this is something that's quite interesting. And when it comes to purchasing power, also quite a good track record.
Is it because they view it as a safe haven? That's why like all the money is going there, like even the institutional investors.
Yes, you are right. You can say that when money channel into bond market, right, then this bond market to them is like a safe haven. They put there first, maybe temporary. If the stock market drop, they could switch back, right? That's true. But just by money flowing into bond market, right, it will not cause the inverted. It will not cause the yield curve to invert, because if the money flow into different maturity, right, like same amount of money buying 2-year bonds, same amount of money buying like the 10-year bonds, right? By right, the entire yield curve will shift down. Because you are bidding up the price for the 2-year bond, you are bidding up the price for 10-year bond, right? And then the 2-year rate also drop, the 10-year rate also drop, right? By right, it shouldn't invert, right? The reason it invert because there's preference between like different maturity, right? That's why, and why suddenly people want to lock in the yield for longer, right? That's the question that we need to understand, right? Because usually when people just want to lock in for as long as possible, right? That's also another message to tell you that, okay, this group of people, they actually is bearish about the economy.
I see. Understand.
Yeah. And of course, these are not just like, like all these investors, they bid up, or it's not purely just trading activities, because there are all other factors. For example, the 2-year is also affected by the Fed policy, right? Because Fed policy, the Fed fund rate is actually the shortest end, right? And that shortest end will influence the 2-year rate as well. Just because of all these, sometimes it's like mathematics. They have to derive the forward rate and so on. So that one is a bit technical, so I won't go into the details. But there are different factors as well. But just looking at 2-year and 10-year, usually it invert when the 10-year rate just drop a lot, right? Yeah, or doesn't increase proportionally with the 2-year rates, and we need to find out the reason why it doesn't increase now. Okay, let's move on. Okay, this one. Will USA still be the big boss for decades to come? US like losing grip of power, like fall of Dutch and British Empire. What if China takes over? Wow, this is getting like geopolitics talk show already. Anyone? This is like I think Corey, you want to give your view on this? I think you have some view on this also, right? Or Maximus?
Can you hear me?
Yeah, I can hear you.
Okay, yeah. I think this is too far out. I don't think it's like. You see, some people have a lot of nationalistic view, right? Especially like China, no. But when it comes to investment, if you use political view and you put investment your money there, I think it can be very painful when it doesn't materialize. But anyway, I think it's very hard to determine. But if China coming up, it's still quite distant. But you want to put your money all in China, I think the risk is very high. So you still have to size your portfolio accordingly if you're really interested. For me, I'm totally out of China now. All right.
Okay, thanks. Hayden, you want to comment on this, or Kelvin? Anyone else want to comment on this or not? If not, I'll just quickly comment. I think they are very hard to know all this, right? My view is that right now, I think US is still the superpower, and in terms of their allies, also they are all the superpowers, right? You just look at US plus Europe, plus Canada, Australia, and Japan. These are their allies, right? So you just add up all these countries, right? I think they are still the dominant power, still the superpower. Then the other side, which is like China, I think China is getting more influential as well, given that when it comes to all these productions, and their market is also much bigger, right? Especially if their GDP per capita increase, right? China economy will be like much bigger than US economy. I think they will become more influential, but whether China will suddenly like become the superpower and just take over, like so-called takeovers, right? I don't think it will happen like anytime soon. But in terms of their soft power or hard power, I think they are still gaining power. They are becoming more influential, and you can see that from the attitude. China is not it's not a country that will just bow to US, right? And they have a lot of leverage when it comes to, let's say, like raw materials, factories, all these things. Is basically they are the world factories, right? So I think there will be more tension moving forward. But at the same time, it's a bit like what they call it, like the frenemies, right? So in certain area they can work together, certain area because of the competition, they will compete with each other. But I think this is the way forward, lah. But when it comes to investment, yes, like Corey said, right, I think we need to, like, if you really bet everything on China, not saying that this is like a bad idea or what, but just need to understand this is a kind of a very extreme view. And maybe I think it's not a good idea to like put on too much all this geopolitical view into your investment. Better just either indexing or better focus on the individual companies, look at their fundamentals. I think geopolitics is just too hard to predict and too hard to make sense of. Yeah, I don't have much insight. That's all for me. Anyone else want to comment on this?
I think I think the country's policies, economic policies, will drive a bigger part in helping us to make this decision. Maybe just to answer this question, just not sure whether you guys agree on this. Is mainly how the country's how the country's leaders formulate their economic policy will largely influence how the relevant companies within the country will how they will be operating from here on, and then that can help us as investors to make this correct decisions. All right, don't leave the geopolitics out. It's better we will be more objective this way.
Yeah, I totally agree. Like you said, all these like government policies, right? There are so many things that government can do that could help certain companies, and they could also destroy certain companies. I think this is definitely true. For example, if you all remember when Trump was elected, right? And then there's some concern on what kind of policy that he will enact, and then the stock market actually dropped for a while, right? Then after that, when he became president, and then he suddenly just do a tax cut, right? And all stock market just rally, right? You know, they just play around with all this tax policy. Let's say if you invest in tech companies and the regulators just step up on their antitrust effort, right? Also can hurt all these companies. I think all these regulations, it could come from US side, it could come from China side, right? All this definitely will affect the companies. That's true. But if you come back to this question asking about like, okay, could actually China take over US, and then all this like very, very like geopolitical tension, I think it's much more harder to predict. But come back to all those like domestic government regulations, right? I think that one you still can understand like what kind of policy that you're expecting and whether they are good or bad for the companies, right? That one I think is something, it is an external factor for the companies, but still quite an important one. We need to know the landscape that they are operating in. And if you are not comfortable with the kind of risk, right, then maybe you know what to avoid, right? Yeah. Okay, let's move on to 3 months into 2022. What are some of the lessons learned, be it experienced personally or from others, such as trade or from book, blog posts, or YouTube? This one I'll go first because I remember there are one friend here in our group, right, that mentioned about like margin liquidation and then just suffer that means margin liquidations. So actually the broker just help him to cut the position at the worst timing, right? So I think this is still a good learning point for me as well. Although, let's say my own portfolio, I don't leverage much, right? Very, very small leverage. I try to play safe, right? But all this margin always puts someone at risk, right? Because I recall that because like IBKR also sent me a couple of notifications saying that they changed the margin. I don't know what they call it, the percentage margin, right? Meaning it just one changes, suddenly you put yourself at a greater risk of margin call or margin liquidations, right? And we have seen people experience this in the past 3 months. So I think this is definitely a learning point, especially given that, you know, companies that cause all this margin liquidation are companies like CE Limited, right? You just need to go back to, I think, let's say 5 months back, right? This company, people are still talking about like, oh, it could go to 1 trillion valuation. And then just within 3 or 4 months period, it could drop by 60 or 70%, right? It's even more and faster than Alibaba, right? We talk about Alibaba for, I don't know, like 1 year already. CE Limited just dropped same magnitude in like 3 months, right? I think this is something that is really quite a surprise for me. Luckily, I don't have huge positions. If not, my portfolio will be very painful as well. But I would say I empathize a lot on with the friends that actually affected by the margin call in companies, in high growth companies. But I think the takeaway here is that we really need to like appreciate that or recognize that all this price movement, right? Sometimes they could be quite stable for a long period of time, and suddenly they become volatile. They could become very volatile, and they can drop quite a sizable magnitude. So we need to be aware of that and don't margin and don't like sell all this put option to the extent that you don't even know how much risk that you are taking, right? So be careful and spend more time to learn about the risk management. Okay, that's just from me. Anyone else want to share? I think this is a good question, right? You can share anything that you like, any lesson that you have learned. I won't call the names. Anyone want to share, just unmute. Anyone? So quiet. Okay. Let's say you're shy to talk. Maybe you can share in the group also. I think this is definitely. I mean, something happened. That's why we have some lesson learned, right? It could be from us personally. It could be from someone else. I think. Let's say if one person make a mistake and then 10% can learn from it. I think definitely something that's good, right? It's always good to have this kind of sharing. But okay, I think that's for this question. Okay, this is two-part. Let me read out the questions. Good morning. I would like to ask, how does withholding tax and expense ratio works when we buy or sell S&P 500 like CSPX or SPI through TD or IBKR? CSPX withholding tax is 15%. How does that work? I sell one CSPX at 450. I receive only $382. Thanks in advance for the clarification. So I think this is quite simple. Actually, the withholding tax, right? You know why it is known as withholding. So the question is, who withhold the money, right? It's actually withhold by the brokerage, and they take the money paid to the government, right? And specifically, they pay to US government. And what kind of money that they withhold? They actually withhold the dividends. So to put it simple is that if you buy and sell, it doesn't affect. How the withholding taxes is on the dividend. Say, for example, if you buy an investment, you buy a dividend stocks, right? 10,000, you receive, let's say 500 dividends, right? Out of that $500 dividend that you receive, right? Actually, 150, 30%, right, will be paid to the government, and you only receive the 70%. So it's always something that is applied on the dividend amount that you're going to receive. That's why when we're comparing, let's say, SPY versus CSPX, right, you might want to say, okay, because CSPX withholding tax is 15% and SPY is 30%, right? The difference is 15%. So you only need to take the 15% multiplied by the dividend yield, right? I don't know how much the dividend yield. Let's say if it is like 1.5%, right? You just take the 1.5% multiplied by the 15% difference, right? You get something like 20 basis point difference, right? So that one become a cost or a difference by investing into like Ireland domicile fund versus US listed ETF. So I think that's something that you might misunderstood previously, because you thought that this is a capital gain tax, right? It is not. It is a dividend withholding tax. I think I answered this question. Should be a simple one. Let's say if you're not you are not clear, then maybe you can just let me know. So I think that's it. Okay, I think we all clear all the questions here. Still got a bit of time. Anyone want to raise any topic that you just want to like bring out for our discussion? I think we can go on for like, let's say 10 or 15 minutes more if you guys are still here. Anyone? Any topics, anything, any news that you are following that you want to share? All right. If no news, let me take a look at the chat group as well. Because, you know, when I'm doing all this, like the TCSS, right, not able to monitor the chat group, cannot multitask. You know. Okay, chat group also quite quiet. Okay, just a small announcement. Actually, yesterday I went out, I met up with Chiking just to do an interview with him, asking me some questions. He also interviewed me. We'll take some time to edit the videos, hopefully by, let's say, Thursday this week. I hope I have some time to edit, and then I'll share with you all. I think that's an interesting conversation. And if you all like all this collaboration, then I'll just like get some help from you all to like maybe like the video, YouTube video, and then give some comments there. I think it helps with the algorithm as well. Okay, I think that's all from me. Anyone else like just anything to bring up? If not, we will end the call here. All right, then enjoy the lunch, everyone. Thank you so much for coming. All right. See you. Bye-bye.
Bye-bye.
Thank you.
Thank you.